Markets responded very favorably to the FOMC minutes as we were kind of on hold without very much of a pullback at all in anticipation of this event. A big news a week. We didn't get the GDP out this morning. We got employment out on Friday. More earnings, including Apple, also had a positive impact on stocks earlier today. Is this it? Are we going to continue to rally from here? Have we set the trend now? Where we don't get the pullbacks, at least on a significant level, or the retest, or have we failed? Is this the move that we've got to the 200-day moving average, and now we see if we fail or not? So I'm going to break all that down in today's video with a trade idea on the stock that's had its own little breakout move today and giving us a good swing trade opportunity. So let's go ahead and get started. Today is Wednesday, January the 30th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the Market Forecast Indicator. And you can see the positive news today, the positive headlines out of the FOMC meeting, pushed us up and through to our highest close of this rally after, again, just really short-term pullbacks. I mean, these you can see the near-term lines. Only a couple of days up above 50 and pulling back down. Now, it's not pulling down to bearish levels, but this high point ended up being a relatively bearish high point, and obviously today bouncing back up again, and still, not getting up through the last near-term peak. So we're not necessarily back to being super bullish yet either. The blue line, at least. The green line is strongly bullish. It's up to the 91st percentile, and we've gone from what was this? The 4th percentile all the way up to the 91st percentile in essentially one big run. It's not very common for us to have that kind of a move just like that. And you've seen it here. And again, we've had one little near-term dip right there at the near-term line below 50. And the next near-term dip right here. And then the next one right here. I mean, these are very, very shallow. The red lines are the Fibonacci retracement levels of this intermediate run that we've had so far, and we just haven't pulled back hardly at all. If I were, oops, we just did 1 second. There we go. So if I were to activate this, and then just throw this onto the near-term low point, then you can see even then, even this near-term run that we had right here, this retracement didn't even get to the 38% retracement of that near-term rally. So very, very shallow pullbacks. Again, hard to maintain too much of a breakout to the upside without that much of an exhale. We are breaking out up above the 50% Fibonacci retracement, which is where the 62% retracement fan was sitting on this big decline that we've had. So a little bit of a breakout there. We're not completely back outside the top end of this retracement zone yet to the upside. So that's something to keep an eye on as we do rally up towards 2,700. Remember, the 200-day moving average is also sitting up here, right in this area, as you'll see here in a second. The short-term sentiment bouncing. Long-term market sentiment is continuing to rise. Hasn't crossed 50 yet, but it's continuing to slowly rise up there. Same thing on the Dow Jones, even bigger bounce today up above these highs than what we saw. And again, just a brief pullback after this one big near-term run. See, this was a big long near-term rally there. Very, very shallow pullbacks, and same thing on the NASDAQ. The NASDAQ still setting up for a bearish divergence, considering that we're already the higher highs, and then the Russell 2000, same thing. It's already up to higher highs and potentially setting up for a bearish divergence. So we'll keep our eyes peeled for that. Simply, again, because of how shallow these pullbacks were. Even just on a near-term basis, that weren't giving us enough of a base that we can bounce up off of. Now, before we look at some other charts here and our trade idea ultimately at the end of the video, a quick reminder, subscribe to our YouTube channel. You can do that right here by clicking this red subscribe button in the bottom below the video. You can also, there usually is a logo here in the bottom right corner that you can mouse over and click on as well. It'll pop out a red subscribe button if you're watching this on a mobile device. Also, click this thumbs up icon here. That will tell us, number one, that you got something out of the video today. It also tells us that you want us to do the video again tomorrow. Quick and really easy, one-click way to give us feedback. And remember, YouTube likes engagement, so even the thumbs down is actually a good thing for us. because YouTube likes when people engage with the videos through thumbs ups, thumbs downs, and comments. So the worst thing you can do if you don't like our videos, actually don't click on anything, because then YouTube obviously does not like that. Going to that, remember, comment too on anything that stood out to you in the video today. Again, when people come and check it out and they check out the comments, they'll be able to see what you got out of it and why they should watch it as well. If you're watching here on our blog, remember we have our calendar over here on the right of classes. I got my portfolio management class tomorrow and technical analysis on Friday. But you can also participate in our forums. There's a link that will take you to our Market Outlook forums. You have to subscribe to our site, so click on this little image here under Join Market Scholars. It takes you to this page. You can see how easy it is to sign up for free for our site. Also down below the video, same thing on YouTube, for the same reasons. Click that little heart there. That will open up a new window. You can click that like button. Also click on this Facebook image, takes you to your Facebook page where you can click on the like there and share it with others. Again, the more engagement on those platforms, the more that they will share this content with other people that like this kind of stuff. It will also tell Twitter and Facebook that you want them to keep sharing you the other stuff that we tweet out there and put out there, and make sure that you get it in your own timelines. Here you can see how we are trading near that 200-day moving average, up above a rising 50-day moving average, and just so far how good the week has been. Reversing what was a week, I mean, as of this morning, we had actually a second bearish week here, because of where we opened, but then, you know, the afternoon obviously closing up to new highs on a weekly basis as well, but still underneath that 200-day moving average. You know, whether or not this is that test of the 200-day moving average, I still don't think that's the case. We usually test the 50 first when we get this far below that. But of course, anything can. You know, if we get a golden cross here, we'll see if that starts our bullish move, our bullish trend back up. And, you know, a multiple, you know, long-term run, just like we had here the last time we were in a global recession. But U.S. slowdown, right? Because the U.S. obviously is not in a recession right now. When you take a look at the 3 green arrow charts, you can see just first of all from the S&P SPY about an average trading range today, with about average volume at 92 million. So go back to SPX and you can see 3 green arrows. The moving average was dropping this last couple of days, so it's turned back up. It will turn back green tomorrow. Obviously I have green shading there. When you look at the 2-line version, you can see again, you know, the little concerning about this run is we just haven't, you know, usually we don't get this kind of a sharp crossover convergence without a retest, and then more of a slower, you know, slower conversions. You can see how we kind of had a move like this over here, and then we weren't able to sustain it. Same thing over here, and obviously we weren't able to sustain it. So usually when we get this kind of breakout where both lines move up so fast, we usually get, you know, a little bit more of a retest down to the 30-day moving average. We just haven't yet. And MACD, as high as it is, coming from as low as it was, you know, again, like the intermediate move, just very rare. I mean, you can see the MACD is as high as it's been the last couple of years, except for that crazy January move. And so, I mean, this is where we're at here. Well, here, let me put on a horizontal line, and we'll put it here at the current level today, which is 24.74. So we'll add this on here, 24.74, and you can see, I mean, again, that's the only other time the MACD has been this bullish in the last couple of years, and it was here in the middle of January when things went so haywire to the upside. Similar haywire move to the upside that we're getting right now. If you were to zoom this out over 5 years, you can see, you know, we had a similar move right here. Coming off of that 2016 low, we had a pretty sharp rally. Was this March of 2014? This was coming after the test of the 50. See, we tested the 50 right there, and then rallied. And then, of course, as well, same thing here, coming off of that again. Coming off of the second low point. Not the first low point, we got a similar MACD move, and then back over here in 2014 we got a similar MACD run. And all of these didn't lead to immediate declines, but they did lead to sideways action. As the MACD pulled back down, you can see we went sideways with some ups and downs. MACD went back down, we went sideways with some ups and downs. MACD went back down, we went sideways with some ups and downs. MACD went back down, obviously we went sideways with bigger ups and downs. So okay, the MACD starts to head back down, we would expect to go sideways with some ups and downs here. The intraday chart you can see now at 268.5 to 243.5. So you're almost about 25 points. You're almost back up to 10% of the high of the range. So just like that, we are moving up, expanding this range out. And you can see obviously a higher high, higher low today. We started out the day higher, so we gapped up above yesterday's high points, and we did get up to last week's high point and held that for some resistance initially. Then of course the breakthrough there at the end of the day up to a new 4-week high. The 4-week midpoint rose up a little bit as well, but you can see again we can drop down to 256 really easily and not skip a beat. And of course there's the Hakunashi Open sitting right at last week's low point, and that seems like pretty far away right now just to get even to that. So lots of support here and a lot of volume coming in. Most of today's volume, as you saw, we had average volume today, but most of it came in at the end of the day. And the trading range that we had, remember you have to include that gap. So it was the average trading range with a little bit more with the gap there. So when you put that in context here, that 92 million is right about in this area. So relatively low. The trading range again was at average of the 4 points, a little bit more. So that's still pretty strong, and we'll see if that's if that ends up being more of kind of a blow off kind of a thing. Now it wasn't that excessive, so I don't expect that to be a blow off top, but it's also a little too much to be really bullish. I mean, there's not any significant resistance we're breaking through. You could say we're kind of breaking through this area right here, and that's what got us to. But you didn't have the strong volume. We didn't have above average volume to do that, and you didn't really have that big of an above average range. And the range at 4 some odd points, with a little bit more actually with the gap, is actually closer to 2% than it is 1%. And more days with ranges around 1% is actually more bullish than more days around 2% or more. Now if we take a look at the volatility index, here's the other thing why I'm not exactly sold on this bullish run, long-term bullish run starting right now without more of a pullback. And the reason being is that volatility is still pretty high. Even with this pullback we pull back down to 95%. We're not breaking the 90%. That's when the bullish trend is established, is when we break the 90% and we get down here towards 15, if not through it. And we're not there yet. And you can see over here, you can see when the bullish trend got established in last year. We broke through 90%. We had a few hiccups, but the trend was established over here. We got through 15, we got through 90%, and we stayed there with some ups and downs, but we stayed down there for the most part. And you can see the bearish trend, and you can see we haven't broken through these lows yet to really say that now this is over, and now we started the bearish trend. So just to kind of keep an eye on that, and another reason why, aside from the seasonality as well, when you take a look at seasonality for SPX, we'll take a look at that seasonality chart again. Again, it's when we're this far up above year-to-date average returns, as you can see. Here we go. We're this far up above year-to-date average returns, like we were last January. Well, we came back down pretty hard to these levels to get back to average. So keep that in mind. That again, are we going to start a new bullish trend from a year-to-date return of almost 7%? Without a pullback down to average? That usually doesn't happen. All right, to summarize, the posture continues to be strongly bullish without really enough of a pullback to sustain such a strong bullish move. So whatever that pullback looks like and whether we've actually had it or not obviously remains to be seen. But based off what we've seen in the past, if we can't really have a 38% Fibonacci retracement without the market going haywire or expecting a bear market to come out of it, and this is all we can handle, then that's not healthy. And we saw last January how unhealthy it was heading into February, and that the more and more we unhealthily continue to move higher without an exhale, the more likely a scenario like that may occur. Now, granted, we can have a scenario like that and still easily stay above the Christmas Eve low point and just move towards the lower end of what is still a really wide 4-week range, and for that matter, a really wide upper half of the 4-week range. So keep that in mind too, and if and when there is any kind of bout of volatility, whether it's by the end of this week or into next week as we trade around this 200-day moving average. So what do you think about that? Do you agree with that outlook? Do you disagree? Click that poll. It's popping out in the top right corner of your screen. Then hit either agree or disagree. If you disagree with it, scroll to the bottom, comment down below on anything that stands out to you. That's different, that you see that would suggest otherwise from what we just surmised from our daily routine. As always, for more content like this in between videos, make sure you follow me on Twitter as I put stuff out there. Also join our community that we created on Facebook to be able to talk about this video, Market Outlook video, with other people that watch it day in and day out. And then finally, join our daily Market Outlook email list that we send out. There's a link also popping out in the top right corner of your screen up there. Click that link to subscribe. Alright, now let's go ahead and talk about what's driving the price action today. And you can see the biggest news today was the FOMC meeting and the press conference. GDP was not released. It's been delayed because of the shutdown, and there's no new release date yet. ADP employment came out in anticipation of the BLS report that will come out on Friday. Over 200,000 private payrolls. Remember, it's just private, so keep that in mind. But the big news was the press conference, and while he didn't commit to saying that the rate hike cycle was over, he pretty much said that they are pretty much done. And in fact, if you look at the odds for a rate hike by the end of this year, they dropped in more than half, from 19% down to 8%, and the odds of a rate cut actually moved higher. So you can kind of see that the odds of rate cut versus a rate hike are pretty much equal, and they're both very low. So by the end of this year, the futures market is expecting that there probably won't be any move from the Fed. And in fact, they also talked about the balance sheet being close to being done too, in terms of getting it down to a level that they are comfortable with. Some people are talking about maybe that that $3.5 trillion mark. As uncomfortable as that is to say, that's kind of where some people are targeting, and they're pretty close to getting to that level as it is. Just a few billion here or there to get down to that level. So that was the news of the day. Of course, the impact it had on asset prices. You can see initially crude oil jumped up really strongly, was up over 3% at one point, and then pulled back by the end of the day. You can see where the FOMC meeting came out, their rate decision and subsequent press conference. And of course, emerging markets really rallied with the drop here in the US dollar. That had the biggest decline. Long-term bonds were down heading into it. They were still down coming out of it. But everything else, right? Gold rallied. Not treasuries, corporate bonds rallied. HYG, high-yield bonds. Preferred stocks were already up, and they went up a little bit more. Small cap stocks went up. Not as much as large cap by the end of the day. And of course, developed markets really benefit more from a falling dollar than developed markets do. You can see, if I were to take a look at the dollar index here, so let's just go to a regular chart and take a look at the dollar index. You can see how we failed at that moving average, and we're starting to continue to trend lower on that. And of course, that has a positive impact on equities, and especially a positive impact on emerging markets, which kind of breaking out here above that high point today with a strong move. And as I mentioned before, that we've been in this global recession, right, for most of this past year. You can see it here, especially you can see it if I were to pull up the long-term chart and look at EEM. So you can see a much bigger pink area than what we saw on SPX, right? So again, you look at SPX. Look at this area here in 15 and 16, and then look at that area now, and you can see the difference, right? That we were in more of a global decline than we were a U.S. decline. But that's changing, in emerging markets as we're breaking up above the 200-day moving average here, getting close to a golden cross. And last time we had that, we had a good rally in emerging market stocks, which led U.S. stocks higher. And as we said before, that could very well be the case again here now, that emerging markets and internationals, and you can see if I look at internationals, the same thing. They were really in decline, and they haven't crossed above their 200-day moving average. So again, the emerging markets benefit more from the dollar, especially if it were to cross below that 200 and produce its own death cross. The other thing too, commodities are generally a good area to be in these late business cycles. Crude oil has been dropping so much, but it's starting to rally higher. Also trying to make its way towards its 200-day moving average, and for that matter, towards its Fibonacci retracement zone of this decline that we've had. So that's going to be another area that if it outperforms and does well, then you would expect. And you can see again, it's had a good day today. If I can get this to sort, there we go. It had a good day today. It had the best day among all these asset classes, and there's emerging markets, growth stocks in the U.S. and the S&P 500, even blue chip stocks did well, much better than small caps and mid caps for that matter, way down here. They were kind of your worst performing equity asset class, just behind dividend stocks. So kind of interesting to see this pairing in preferred stocks down at the bottom. But again, from a 3-month standpoint, emerging markets, they're the place to be. They're way outpacing ACWI, which is way outpacing, not way, but it's outpacing the U.S. stock market. So, globally has been the place to be over the last 3 months, and you would expect that to continue to be the place to be if the dollar, UUP down here, continues to drop, right? And you would expect this underperformance, a significant underperformance in commodities, to make their way back up towards the top of the chart as well. Real estate, you can see, has been a good asset class. Gold, you would expect to continue to be a good asset class. You can see long-term bonds. The other impact of this dovish Fed is for bearish yields, and so you would expect long-term bonds to also be up here. Probably not as high as equities, but still make its way up here as these yields start moving their way back towards 2.6% and potentially back through 2.6%. Now let's take a look at the sectors and how they performed here. We'll take a look at the S&P sectors. You can see the better performers: real estate, not surprising; materials, also not surprising with the weak dollar. Energy was at the bottom. Today, look at your cyclical areas really taking off. You're in your kind of dollar sensitive areas, also kind of matching the market, a little bit of lag in materials. Financial struggling with the falling yields, that's not surprising. And then your interest rate sensitive areas as well as your safe haven areas going up, but not as much. So if I were to look at those sectors on a 1-year chart here, so right here, or 1-day chart, sorry, and just look at them today and how they performed, you can see there's technology, and it started off today strong with some positive earnings, right, from Apple, but then took off and finished today above 3%. Consumer discretionary also outperforming by the end of the day. And then, of course, your safe haven areas were already lagging on this bullish upward move, and they finished the day down, still up, but way behind the market by more than half, because of this kind of flight to risk, right? It's this risk appetite. If you look at this the last 10 days, you can see that industrials, real estate, materials have been strong, and that's why these areas, especially materials, was a little bit weaker, because they've got the strong gains. It's already they're kind of giving back some of that, and why communication services has been a little bit of a laggard too, because it's been a laggard. It was actually down over a 10-day period 2%. It's just now starting to make its way back, whereas technology and discretionary were already showing relative strength and continued that through the earnings announcements that we saw today. All right, one stock that came out with some good news today on a drug front is Mylan. You can see it had a breakout move. Of course, had a drug approved. Had a good spike in volume. There's your breakout above the upper Bollinger Band with the bandwidth being relatively low. and not very much volume until you get up into this 36 and higher area where you do have a lot of resistance. So kind of this vacuum, really easy because we dropped so far so fast, really easy to get back up through there, especially when you have the 3 green arrow signal, right, and the spike in volume that you got today. So there's all 3 green arrows. Of course, the moving average will turn green tomorrow because it's at 28.47 yesterday. It was at 28.53 today, so it will turn green tomorrow. And if you take a look at the market forecast indicator, it's also turned dark green with the dark green area there. So very good sign from a long-term perspective. Mylan's been bearish. It's got some gap to go to fill in to get towards the 200-day moving average. It's been in this kind of decline, so it's got some room to run. So we can be bullish here and manage our risk. We can buy this at the money option April 18th. If you notice, if I go back to the Bollinger Bands here, the current pricing gives the stock the potential to get up to that area 36 by about April the 3rd, the very beginning of April, at current pricing levels. Of course, anything can happen, but at current pricing levels, they can do that. I threw that on the Theo price here. They get to April the 3rd, to get to 36, and you can see that if we got there, we get about a $3.40 gain. If you're going to put $1.30 at risk with a 50% stop order, then you more than get a 2-to-1 reward to risk ratio, if not more. So there's an opportunity here to make a pretty easy swing trade on this stock up towards that resistance. You don't want to expect it to break through that resistance because that's a pretty heavy low up there. But there's a vacuum up to that point. So now we might have some pullback here in the short term. As it reconciles this big extreme move that we had in one day. Again, you look at the last indicator that we usually look at here at DMI, and you can see the cross that we had. Here, let me bring up the DMI indicators. The cross that we had above 25, above the negative line, and above 25 with a low ADX suggests that we can get a trending move to come out of this. With this big move, especially with the break above the upper Bollinger Band. So there's opportunity, and there's a pretty decent reward to risk ratio on a long option trade to be able to take advantage of that opportunity. The spreads are relatively wide, so almost 19 cents, so it's not quite 10%, but it's over 5, so you have to make sure that you get filled in an area. Like right now, you can see the market's telling you probably get filled in at 261. But you have to see, you might be able to get filled in somewhere over here, depending upon how active the market is, especially for volatility buyers, which is what you would be if you were buying this long call option, because long calls have a positive vega. All right, so that wraps us up for today. Now I want to hear from you. Use that link in the top right corner to take you to the forums. Remember, that same link is above the video on the blog. You may have to subscribe to our site, but I showed you how you can do that for free earlier. But let's hear from you. What comments, questions you have for me about what we talked about in the market outlook, or questions or comments you have for me or any other market scholar for that matter about something we didn't cover in the video. So let's continue the conversation over there. Thank you for very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment. Also remember to follow me on Twitter for more content like this in between videos, and join our community on our website at marketscholars.com, as well as the Facebook group we created for the Market Outlook. So again, have a great rest of your evening, everybody, and we'll see you all next time.